Thank you. So my name is Dr. Gauri Sinha, and I am a lecturer at Royal Holloway, University of London. I teach financial crime. I've also had various practice experiences in financial crime, well, in anti-financial crime, not in financial crime, obviously. My last role was at PwC. So I worked with PwC twice, and I've also worked with the World Bank. I've also worked with the government twice as well. So I'll keep it short, but yeah, I think that gives you a sense of who I am. And Andy, would you like to introduce yourself?
Hi, good morning. Good morning still. My name is Andy Mcdonald. I'm the global head of screening, filtering and risk rating at Deutsche Bank. I spent most of the last 20 years actually in consulting. I was a partner at Deloitte for a number of years, working out in Singapore, Southeast Asia, also in Canada. Been working in financial crime since around 1999, which starting to sound like quite a long time ago. Anyway, I'm very happy to be here, and hopefully we'll have an interesting discussion.
Andy, that's an impressive background. It's kind of hard to follow. So I'm Kevin Goschalk, the CEO and founder of a company called Arcos Labs. We're headquartered in San Francisco. I'm originally from Australia, you might know. I think my best credential to being here, I was born an Australian, so we're all convicts by birth. So who better to talk about fraud than Aussies? So we're in the business of helping protect account security. So that's the big use case, stopping bad actors from compromising accounts, convincing people to give them their credentials, all that fun stuff. And really the way we do it is just make it more expensive than the amount of return on investment they get back from that attack. And if you do that, they will go get another job or they will go attack a different bank. So, and we're fine with either or really. So.
Great. So let's start the discussion. So speaking of fraud, Kevin, I'm not picking on you, but I wondered if we can start with you and just speak about post-COVID trends. And I do think fraud is a big one, and hence my reason of starting with you. So do you feel COVID-19 has changed the battle? Are there any new risks, specifically when we talk about fraud?
Yes, there's quite a lot of new things. So I think one thing that I've always enjoyed about working in the security space is the creativity of the adversaries. And they will take advantage of anything they can possibly take advantage of. And through COVID, we've seen a lot more people moving to using cards, buying things online. And that's like a pretty dramatic shift in consumer behavior. It's also required a shift from merchants to, instead of just having retail stores, you've got to be able to sell things better online. You've got to improve your online store experience. Suddenly, companies are opening up fraud avenues that they weren't really used to or familiar with. And they're getting a lot more digital transactions than they were previously. And bad actors figured out ways of taking advantage of this. There's a lot more people that weren't really buying stuff online that are now using their cards in places where may not be actually what they think they're using their card on. There's a lot more phishing campaigns, people taking advantage of folks expecting government payouts to help them through this process and kind of through the world we're currently in. So they're kind of waiting for someone to be like, here's the email, click the link, enter your bank details, and we'll send you the government funds that we promised you, and now their entire account's compromised and all their money's gone, all their life savings. So unfortunately, yes, there's been a lot of people taking advantage of, I think, people around the world that are in worse circumstances and situations. And there's been a lot of really evolved they always are evolving, obviously, but we've just seen a continued double down and investment from bad actors figuring out new ways. Like phishing used to be just emails that you would click on. We're all very familiar with phishing. I know a lot of people here are talking about it. But now there's really advanced forms of like vishing, which is where they call you and they try and convince you to give them your one-time PIN as they're trying to log into your account. Now there's automated versions of that, so you can actually start scaling phishing campaigns. So you can buy software that will actually call somebody automatically, and it sounds like an automated robocall from a bank, and they're saying, you got to respond to this, type in your PIN, so we can continue this fraud check or whatever it is, and then they just obviously compromise their accounts. So we're seeing all kinds of fun stuff happening in the fraud landscape right now, and consumer behavior has driven new ways to abuse people, unfortunately.
Yeah, and transactions have become more global, as you said. Right. We can now buy things from anywhere. Enter our bank details, and then, this is obviously post-COVID, it has even heightened this. So yeah, I'll come back to fraud, but financial crime risks, Andy, in terms of the broader financial crime risks and not just fraud, are we seeing any new trends in the industry post-COVID or during COVID?
Yeah, I think I haven't seen a huge amount that I would put the blame on COVID for around financial crime, but I think that this sort of time frame has coincided with increasing sort of macro and micro political changes, and most recently, obviously, Afghanistan and the speed with which Afghanistan went back to the Taliban after 20 odd years, and the speed with which financial institutions have to react to that. Financial institutions going from cautiously trying to, assist development in Afghanistan, cautiously trying to broker trade, obviously within regulations and laws, and suddenly that's more or less shut down, and so you then have to reverse, that position, as it were, and change your controls in a sort of overnight. But similarly, in the last few years, we've seen the Paradise Papers and things like that. So that was a whole different sort of set of challenges for institutions to deal with, where suddenly they're being named, their clients are being named. Suddenly it's on the front pages that you have clients in these sort of jurisdictions that may or may not be breaking the law, but either way, it doesn't look great. So those sort of changes have come in, and we're now seeing sort of Belarus. Obviously, in recent years, Russia has changed somewhat in terms of expectations of treatment, and just the speed with which countries, particularly the US, but not just the US, are putting sanctions on individuals, organizations, countries. The complexity of those rules, I think, is ever increasing.
Yeah, I agree with you, but I do have a thought. It is true that there has been quite a lot of spotlight on high-risk countries and political tension, etc. But we have had a response from law, haven't we, in terms of the Fifth Money Laundering Directive. We've had a response in terms of the implementation, when I talk specifically in the UK perspective, of the implementation of the Fifth Money Laundering Directive. And it has brought about certain amendments, particularly with regard to high-risk third countries, beneficial ownership, and all the issues that you just touched on. So are we then saying that the law is not effective enough, or I don't know how to put it, effective enough or good enough? Sorry.
No, sorry. I don't think it's a challenge of law, to my mind. What I think is an interesting trend the last few years, and I'd be interested to know if the audience has seen this, if it's just me, is that regulators are getting into another sort of level of detail around how controls are being implemented and executed. And so several years ago, let's say the Afghanistan situation had come up several years ago, the question would have been, how many clients do you have with connections to Afghanistan? What types of books of business is that? And they would have given you some time to collate that information. The expectation now is that you know the answer to that overnight, if not before the issue comes up. And the same with the sort of controls you implement. Back in my consulting days with when it came to transaction monitoring, the regulatory expectations were that you show them you had a set of scenarios that were effective, that you did some sort of testing, and then within reason, and this is generalizing, but within reason, the regulators would go, okay, that looks fine. Your numbers are similar to your peers. Now it's, no, we need you to take us through exactly why you think this is the right scenario, and then also why this is not the right scenario, and show us all the way through that. And I think just the level of detail regulators are going into on those controls, to me at least, seems to be much deeper than it used to be. So I'm not sure it's a legal thing more than a regulatory expectation side of things.
Yeah, from my experience, that is correct as well. I mean, I've worked with several clients where they're struggling to interpret what the expectations are, and in a way that does link to legal, because the regulator would then say, well, these are the amendments, this is what you need to do, but then how to do it and how to kind of integrate it into your current systems is another story. So let's now link fraud with financial crime. And one thing I hope the audience is interested to know, I'm really interested to know, is the response in terms of linking the two. So as I said, until last year when I was with Pricewaterhouse, we had several discussions on, or conversations around, are fraud and anti-money laundering, for instance, being dealt with in separate compartments? Is there any scope for integration? Is there any scope for a more harmonized, synchronized approach so you're able to fight the crime better? And there were various different opinions on this, and I remember having some conferences like this on this very topic. So I would really be interested to know both your opinions on this. Kevin, sorry.
No, whoever.
Yeah, I think that's an interesting trend that we've seen as well. A lot of the teams aren't
Yeah.
talking to each other.
Yeah.
And when it comes to fraud, really it starts as a security problem. Then it kind of turns into an identity problem. And then it kind of becomes like a fraud problem. It doesn't really start as a fraud problem. And a lot of the teams in the fraud departments don't really think of it like that. They're really focused on, my problem is fraud. I'm trying to mitigate this. It's bad transactions. I got to like look at it from that perspective. And one of the things we always try and encourage is like, you know, what's the root cause, right? The root cause is not the fraud. That's kind of a symptom of the root cause, which is bad actor compromise or accounts being leveraged for money muling or whatever it might be. But that's kind of a downstream piece of it, and maybe you can speak kind of to the financial crime side.
Yeah, I mean, it's an interesting question. It's a question that I've seen for 20 years, people saying we have to bring money laundering and fraud and whatever and sanctions into one place and run it. You know, there's a lot of synergies. And whenever people try to do that, they then realize that there are, I think, fewer synergies than they think. And then somebody solves some problem and then they decide to bring it together again and then they split it up and then bring it together and then split it up. And it just seems to go through that cycle. This is my personal experience, not in my current institution, but in previous years. And I think there are fundamental differences in the sense, for example, with fraud, that you're hopefully trying to stop something happening before it happens. And money laundering, of course, you're trying to do that, but you're also making sure that you can do your regulatory reporting and you can take action on historic activity. Because until you see the patterns of behavior, you don't necessarily know that there's money laundering happening. So I think there are some synergies, maybe on the technology side. Transaction monitoring, for example, would seem sensible that you are using similar systems and data to monitor for suspicious activity from a money laundering perspective and to identify transactions from a sanctions perspective that you're using to identify similar activity from a fraud point of view. But trying to do all of that in one go, you sort of wonder whether maybe it's better to keep them separate, which is, I think, what a lot of people do. So I can see the arguments both ways. I don't think there's a one. It's a bit of a cop-out, but I don't think there's a one right answer. But the opinions on it do seem to have changed a lot over the years, and I'm sure will continue to do so.
Yeah, it's a debatable issue, isn't it? And also, fraud is a predicate offence for money laundering.
Right.
So, yeah, fundamentally they're of different nature. So yeah, that is an issue that still needs to be talked about in industry, I think. So, going from problems to solutions, I think we should speak about what needs to be done. So what financial institutions or what regulated entities in general need to do to develop a better response towards financial crime. And it's a very broad question. So when I read this question, I was like, oh, can we really answer this, in a panel discussion? But let's try.
It is a broad question, so I'll start with a broad answer. I think the regulations globally make some very good points, such as you have to assess your risk, and then you have to implement controls that are aligned to that risk. And I think it's remarkable how many institutions, small ones but also some large ones, don't get those steps right. The risk assessment is a fundamental basis, it should be a fundamental basis of your financial crime control framework. Where are your risks coming from geographically? Which books of business are affected by those risks? What types of customers? Whatever it might be, that assessment is fundamental. And that assessment should also work hand in hand with your risk appetite. So I know I have these risks. Am I comfortable with those risks? Am I okay to be building out my wealth management business in these countries that are high risk? If I am okay with that, it's not necessarily, the answer doesn't have to be no, but if I am okay, what does that mean in terms of additional controls over that sort of business? And I think that the first line, as it were, of the regulations globally tends to say you should do that.
Yeah.
And people seem to gloss over that and then get to the other bits, or do it, sort of halfway and just think it's all right. And then don't change it over time and don't look at upcoming threats. Don't look at activity in the past and say, how does that feed into my current perception of risk and how it impacts my firm. So I think that's a fundamental starting point. And if you get that right and your risk appetite, it should be relatively straightforward to then look at, well, which of my controls don't match that, right? If I look at my transaction monitoring controls and I look at what weaknesses I have in that from a geographic perspective, are those weaknesses in high-risk countries? And if they are, does that match with my risk appetite? Because I said my risk appetite was, I want to build my wealth management business in this high-risk country, and my risk appetite is it has to be well controlled. But I'm saying over here, internal audit are telling me I don't have very good transaction monitoring. So how are those two tied together? And those are the questions regulators are asking as well. It's like, show me you've made this decision to enhance the control, to hire more people, to get rid of people, whatever it might be. Show me why that is in accordance with your policies, but also your risk appetite, which is signed off by your board or whatever your equivalent body is. So ultimately, the board is then asked by the regulators, well, you told your bank that your risk appetite was this, and they did something different, and nobody thought that was a problem. I think that's a fundamental question. So I think that starting point is still missed by a lot of institutions.
Yeah, I think that's a great kind of overview on how to think about the situation. We obviously, from the criminals' perspective, we've seen them obviously target the places with the lowest security controls, but also the ability to kind of maximize that return on investment. So, even though they might be based in, say, India, they're not really attacking firms in India, is what we've seen. They're attacking countries that it's more lucrative, it's easy to get through, the government regulations may be more lax, so there's a lower KYC process they need to go through. So they're always going after a path of least resistance. Where can they find the most amount of money for the lowest effort, cost ratio? So it's kind of interesting to think about it from like a geographical standpoint, because your threats aren't really going to be necessarily from that same location, right? So if you're planning to open a new bank in a country where regulation is very light and like your onboarding process is a lot lighter, you're just going to get more fraud there, whether or not they're coming from that country, because it's going to be a more lucrative target for global adversaries coming after you. So that risk-reward ratio is also how the fraudsters think about it, interestingly enough. So it's always fun. It's always a fun part of the game.
Yeah, I mean, that's one of the big differences between money laundering type financial crime and fraud is that a lot of the fraud is committed on your customers, not by your customers. But most of your money launderers are your customers. Yeah. And so there's a difference in terms of who you're trying to stop.
Yep.
Yeah, I think speaking of global regulations, it doesn't help. The complexity of regs don't help either. So, again, going back to the money laundering regs, they have chosen to gold plate what is there in the UK. So we have different or enhanced kind of regs here. And then I've seen like clients struggle with that because, well, if they have, for example, an overseas customer, then which regs are you following? If you are following the UK regs strictly, then you are gold plating it. You're doing more than you should in a way.
It's more friction too, right?
Yeah, exactly. So that does create more complexities. So let's also, bearing in mind the time, should we move on to the big one, AI and ML, so artificial intelligence and machine learning? And I say it's a big one because it's still one of those things that's been debated. We don't know whether it'll work or not work. So do you believe that AI, ML, and big data technologies improve identification processes?
Do people still ask if it works? Don't we know by now? I feel like we know that it works by now.
Well, yeah, my experiences have been mixed.
So if you have a billion rows of data, you're going to have a human sort through all that by hand to find the anomalies? I don't think that's... I don't think people do that, surely, nowadays.
But I mean, that there is a difference, I suppose, between rules-based sort of analysis and AI. I mean, transaction monitoring is something I've been involved in for, again, 20-odd years. And even quite early on, Searchbase was one of the first firms in that space from a financial crime point of view. And one of their big technologies was, I can't remember, I think the terminology was comfort blanket, but you'll excuse me because it was 20-odd years ago or 15 years ago. And that was an AI.
AI and 15 years ago.
Well,
still talking about it.
No, well, for sure. But the thing was that the idea was you put in your rules to identify suspicious activity, and then the comfort blanket would be there that would also would use machine learning or whatever the neural networks to identify other activity. Right? That was the hypothesis. And of course, it's older technology, but still. But it's interesting that a lot of those systems have migrated since then to stop using AI and to move to more rules-based for two reasons, I think. Firstly, it was more, you had less of the black box issue, right? Particularly with earlier AI, where it tells me this is suspicious, but I'm not entirely sure why. Whereas if it's a rule that tells me, it can tell me exactly that this client has done 4.8 times as much activity in the last month as they've done every month for the last 10 years. And the other reason is it's easier to explain to regulators. And I've been in a discussion with a regulator in a country I won't name who my client was a financial institution at the time, and the financial institution was saying, look, we want to hire a load of big data experts and for a lot of money and put them in a room, and then they can build the right sort of systems to identify suspicious activity. And the regulator said it's a brilliant idea, but you're not turning off your transaction monitoring system. You need to do both. You can't just do one. Now, I think now we are getting to the stage where some of those challenges are going away, but it's taken a long time to get there.
But I think what you said is correct. I think the answer is closer to both, not just one. I don't think you use AI and replace like all your rules.
Yeah.
Obviously, there's a lot of very obvious rules, like someone's making a transaction in a country that's too far from where they just left, or there's just physical limitations to certain kinds of events. That's like, yeah, that should just be a rule. You don't need AI to tell you that that can't be done. It's like, we know that can't be done, so that should trigger a rule. Right. We've had a ton of success with anomaly detection, which is obviously a variant of AI where you're looking for unusual out-of-band activity. It's like the normal activity is this, and now suddenly we're seeing this, and then it goes back to this. I was like, okay, what happened there? Figure out the delta between that and what the regular traffic trend is during that time. So it's pattern matching, I would kind of simplify AI as, which does work, I think, quite effectively in certain scenarios. But yes, you still want to keep rules in place. And you still also need people to check what the AI is doing. You got to have feedback loops. If you're letting the AI come to conclusions and then block and deny and not really have a way of saying, was that actually correct? Like, how are you confirming that was correct? So I think AI has to be quite heavily supervised in many ways. But feedback loops are very important. One of the benefits from like fraud, you get like chargeback reports from like a customer. It's like, I didn't make that transaction. That's a feedback loop you can use to say, actually, all of these transactions, these ones are getting charged as claimed as chargebacks. These ones are not. The AI said that these were malicious, so it was wrong in that case. Or maybe the AI is saying these ones are malicious, and then none of them had chargeback complaints. So that's all useful information to kind of train the system.
Yeah.
But yeah, it's more than just looking at data. There's a number of pieces to it. And
isn't it a challenge to implement when it comes to legacy systems? And that's one of the main things I have noticed, that yeah, it's all good in theory that all this should be there, but what about the implementation bit? And I know from a project I did with the government is that the regulator is really concerned about encouraging it at the same time, but also quite concerned about transparency and trust issues, and that it's going to open up a whole box of like problems, So yeah, I agree with the theory, but I think there's still a lot that needs to be unpacked and a lot that needs to be understood about AI before we can actually say that, yeah, that's the way to go, or human in the loop is the answer, or anything like that. So in terms of coming back to the threats in your specific sector, so we've talked about like threats post-COVID-19, we've talked about AI, we've talked about fraud, money laundering, whether it can be integrated or not. Are there any specific new threats that affect your particular sector?
I think it's a bit of a cliche, but the only certainty is there is no certainty, right?
Yeah.
And you look at all the political events that I talked about before, and we don't know what the next thing coming over the hill is. I think I prefer to look at it as, how do you ensure that you're prepared when those events come in a timely manner? And it comes back nowadays, in my mind, to data, because the data is all there within the institution. Yeah. But unless you are, I always feel jealous of people who work for startup banks, because you don't have 500 KYC systems and 300 core banking systems to integrate. I'm sure there's someone here from Startup Bank who'll go, yes, we do. But anyway, if you could start with a blank sheet of paper and say, we want one client system, one client database, we want one core banking system, we want them to be speaking to each other and to do all this stuff, that would make life much easier. Reporting on that is much easier. Whereas every large institution I've ever consulted at has never really had any of that together in one place. And what I'd like to see institutions doing is being able to model events that might happen in the future. So let's take Afghanistan as it's a recent example right now. Maybe most people didn't expect Afghanistan to be in the state it's in quite as quickly, but it was clearly with the US and other forces leaving, it was clearly going to fall to the Taliban at some point. Yeah. So what would be nice as a financial institution is if you could model that, if you could say, okay, well, tell me early on what would the impact be on our business, on our books of business. What relationships do we have with Afghanistan? What clients do we have with links to there? Whatever it might be, as a heads up. I remember years ago when Greece was in its big financial crisis. There was talk about Greece potentially politically failing. Yeah. Maybe that would lead to it leaving the EU. All these things could have happened. And one of the questions was, well, if that were to happen or were to have happened, then does Greece go from a low-risk country to a medium or even maybe a high-risk country from a financial crime perspective? Let's say it does. What does that mean for my book of business? That's the sort of question that I think businesses up to the board level need to be able to answer, hypothetically. Right? If we see these things coming over the hill, who are the people I need to speak to? On the day that happens, who are the desk heads I need to call, and what information do I have ready to tell them? Right? These are the 50 clients you've got to exit. These are or whatever it might be. And I think that's an interesting way of being prepared, but requires the data, requires the analysis to be available.
I guess that'd be kind of interesting, like in the context of like COVID. That's a pretty catastrophic situation for the world, right? So having all your employees have to work from home, that's a very different security risk profile than people coming in to work, at the bank, right? Like, I think we've seen a lot of companies struggle to figure out like how do we move everything online, especially from an IT security standpoint. And then of course the consumer change. I think the other example would be like, what would be like a world war? What would that be like? How would you model that? And what are all the downstream impacts from something like that? So. Yeah, that's a good way to think about it. I'm sure someone has a book somewhere with like all these scenarios, and it's like, this is what we do, this is where we go. Probably no one in this room, but I'm sure someone's thinking about it.
I mean, how far are we going to look ahead though? Are we going to prepare for a pandemic when a pandemic is not a usual occurrence?
It's not really happened before like this.
No.
So, and not during a world where travel is like a normal thing, and now travel is really tricky.
Where KYC is a big thing.
Yeah.
I mean, not in a world where KYC is a big thing. So, yeah.
Although people have been warning about it for years, right? I mean, the pandemic, maybe not as it actually worked out, but there are movies that said this sort of thing can happen, right? I mean, some of them are good movies, some of them aren't, but there are movies that said this might happen. There are a lot of epidemiologists who said, these sorts of things can happen. And I think the problem is, I lived in Asia when there was swine flu and all these other things came up, and we were all told, it's going to be a zombie movie basically, and it never happened. Now, fortunately, we're still not quite in a zombie movie, but it's obviously much worse than swine flu, nearly. Yeah. Swine flu and so on. But these things have been warned about, and I suppose the question is, which ones do you pay attention to and which you don't? And that's an impossible question. But the better your data is and the better your analytical tools, the easier it is to at least be ready to model that activity in the future.
Yeah, and I would say also more than data analysis, because what you're suggesting, Andy, is a very strategic approach, isn't it?
Yeah, I think so.
It's someone who can really look into the future and say, well, this, and this could happen. And then do we have the processes or the data to be ready for it?
Yeah, I mean, another way of looking at it is, banks have to perform. I forget the word, but have to perform tests to demonstrate that if a book of business collapses, the whole the whole economy won't come down with it, right? If everyone defaults on their mortgage, does the economy go down? Yeah. Well, there are other things you should, from a financial crime perspective, let's model on an annual basis. Let's do dry runs of modeling. If tomorrow a certain country gets taken over by a far right-wing government or by a terrorist state or whatever, let's model that and say, well, what's the downstream effects of that, and how would we be ready to react to that from a regulatory perspective, from our client's perspective? So there are ways of doing that are considered, I think, in other areas, which maybe we can think about more in financial crime.
Yeah. Speaking of that, like resources is a big one, right? Because we are always talking about the cost of compliance. We are, and all the clients I've worked with, all the financial institutions are talking about the rising costs of compliance. Is this something that is still a worry for firms? Kevin, what do you think in your experience?
It's a good question. I think we've seen a lot of companies that we work with move to different market segments and things like that, and the regulation requirements, like I mentioned earlier, are quite different. Yeah. So like the overhead to support in one market might be like an entire team of people, just because of and you need to have 5-6 vendors, you're going to have all these different components that go into it, and that increases your cost of delivery of the same service, which you might be offering in a different market, which doesn't have that same barrier. I think it's a potentially a competitive advantage to certain companies that maybe are incumbent in the market, that entering that market makes it more difficult because you're more familiar with the regulations. You've kind of built your company around it. So it's kind of interesting. I think it does make it harder to compete for some companies that are trying to become more global and things like that. Yeah, it's resources is always what it comes down to. Is like, is the investment going to be worth the reward from that for moving into a new region or opening a new branch, or what it might be?
Yeah, the cost-benefit analysis. Yeah.
Simple, right?
Yeah, yeah.
Yeah, I mean, I think it's interesting, the idea that sort of financial institutions have spent so much money over the last few years, many years in some cases, in building up increased resources, increased technology, and getting better at fighting financial crime, and the idea that that's sort of ending. And I think if you look at most financial institutions, large or small, and you chart their growth in terms of staffing, it looks something like this, but it doesn't look like this yet. I don't think it's leveled off yet, and I think that's because the regulatory expectations are still increasing. You look at how many institutions are still under cease and desist orders, still under, in the UK, a skilled person, for example, monitorships with other regulators. Like those regulatory actions are still sitting over a number of large financial institutions, many large financial institutions, and a lot of smaller ones. So they're clearly not, they haven't got everything right yet. And then those regulatory actions are then happening anew for other institutions, or indeed the same ones again. So I think it's a long way to go. I fell accidentally into anti-financial crime back in the late 90s and never left it, but people then would go, well, what are you going to do when that work dries up? So I don't think it's going anywhere, and I don't think it's fixed yet.
I think the other interesting thing is all the neobanks, the challenger banks that are able to kind of get away and move much faster. They have lower regulatory tape. I think it's kind of fascinating. Like Chase, one of the biggest banks in the US, launched a neobank in the UK. They didn't launch like the full same kind of thing that they do in the US. They actually launched something more equivalent to like a startup bank.
Yeah.
And what's the reason for that? Probably because it's faster to launch it. Probably a good place to get started, get your brand, get built. I'm sure they have a whole bunch of reasons, but it's kind of fascinating to kind of see that delta.
Absolutely. No, there's a long way to go. Our careers are not going anywhere, that's for sure. Shall we go to questions? Because we have about 10 minutes left for questions. I'm going to start. I've got some questions. Oh my God, I've got many questions. Many questions on the online side of things. But can we go to the room first? And does anyone have any questions?
Everyone's got used to using Skype and
people are like,
being anonymous.
We don't know.
Microsoft wish it was Skype.
Well, okay.
Yeah.
I also asked the question online, but what are your experiences with working with law enforcement and collaborating with them on the fraud side?
I mean, I haven't worked much in the fraud space, to be honest. More money laundering and so on. And I mean, the interesting thing with you were talking earlier that you can tune your fraud systems by finding out if someone actually did commit fraud and then feed it back. One of the big problems we've got, I think, in money laundering is you don't know if someone's a money launderer, right? You report to law enforcement or to the regulators that you send your SAR in, and then it's sort of, you don't know. I mean, that could have been fundamental in causing the arrest of 5,000 people in Guatemala who were involved in something, but you never necessarily know that, or you almost never know the answer to that, and that's one of the challenges. And I think, I mean, I've worked with law enforcement in a number of countries. I think we're all sort of working on the same side, but the inability, and it's not deliberate, but the inability to have that feedback loop, I think, does make it challenging. We don't know if what we're telling them is helpful or not, except sort of through hints. We certainly don't know, yes, that's exactly what we want to tell you and tell us next time because we arrested someone because of it.
Yeah, I think on the fraud side, interestingly enough, if they're good at what they do, you can't really easily trace it back to them. So it's actually quite difficult to actually catch the person, and almost not always really worth the effort. So people typically tend to focus their effort on like, how do we shore up our defenses from these kind of attacks actually occurring versus trying to go after the individual. There are certainly a lot of examples of that where they do work with law enforcement, but I think it's quite difficult to do so. It does require an incredible amount of data, and it would require them to be basically unable to kind of stop the kind of fraud that's occurring, right? So there's something about their business or their product or their service that they're offering is just fundamentally easy to defraud, and someone's, you know, kind of taking them to court on it. And yeah, honestly, I haven't seen a lot of success with law enforcement in the fraud space, unfortunately.
Yeah. I have a few questions here, but just a little bit of housekeeping. If you do want to ask a question online, you need to go to your Brella app, bottom toolbar, look at the 3 dots, and then the Q&A. All right, so this is, I think, one for you, Kevin. What are the main regulatory challenges in combating fraud?
Yep, it's a good question. So privacy is actually kind of interesting. Obviously, there's GDPR in Europe, and that actually makes it kind of tricky to combat bad actors. There are carve-outs for cybersecurity, but collecting certain information, sharing that data with providers that you might be partnering with for fraud mitigation is actually really hard. You know, sharing personally identifiable data. That is actually very valuable for fraud detection, maybe no surprise, but having additional signals like, you know, who they are, where do they live, where are they coming from, pairing that with device information, what phones do they own, what's their behavior as a consumer, what are their transactions they typically make, where are they buying things from? Like, that data is, of course, very, very personal and private. You don't want people to be aware of it. But that's something that we've seen be quite a difficult, thorny problem. The other component is, and maybe one of the benefits actually, over here from what we've seen in the US, is in the US, it's not normal to have a very strong KYC process. The KYC process is pretty light. Like, you can buy stolen identities that will get you through KYC. Like, it's actually not that difficult in the scheme of things. It costs you money, so there's a cost to do it, but you can get through it if you want to get through it. Yeah. So there's not like a hard gate to actually stop someone from creating a fraudulent account or a fraudulent identity. You just buy the data. Whereas over here, I think the checks and balances are a lot stronger, and there's continuous authentication, and there's other ways that are being regulated that are, I think, more beneficial. So it's really kind of, it changes depending on what markets you're in and those kind of things.
Yeah, great, yeah. This is a good one. In financial crime discussions, we mostly focus on banks. Where do you see key risks for other financial service organizations like an insurance company?
Well, I don't work for an insurance company. I did used to. I mean, insurance, for example, I think a lot of the things I've said already, depending on your geographic spread, are true, right? That you still need to be prepared to understand what's coming down the pipe. I can't speak to specifics of insurance or really outside of the banking industry, but the speed of change and the speed of regulatory expectations is I'm sure still there for insurance. I think, I mean, there are some industries which I have worked in which are getting up the curve, which is quite interesting. Like casinos is a good one, law firms, places like that where you know, it's traditionally been banking and then to some extent insurance and obviously asset management that is concentrated on financial crime. But and casinos, particularly in certain countries, have been really able to do whatever they liked. I remember, I won't name the country, but I'm working with a casino there who were trying to explain to me why there was nothing unusual about bringing a satchel with $200,000 with you to the casino. Now, I don't mind, I quite like going to Vegas myself, but I've never bought a satchel with $200,000 in it. And if I did, I wouldn't consider it very normal. And what's interesting is as these sorts of new industries to fighting financial crime are moving in, you suddenly need a whole different set of processes, a whole different way of reacting to things that you know, people in the industry for 40 years thought were perfectly normal. So not sure that's particularly helpful to the person who asked the question. But
in the UK, though, the FCA has recently published a lot on insurance, financial crime, in case you're interested. Yes.
Hi. I'm Balaji. I'm the head of security at Metal, which is a FinTech venture by NatWest Group for small and medium-sized businesses. My question to this panel was, have you seen reduction in fraud as a consequence of the strong customer authentication legislation?
So from the fintechs we work with, there's definitely a correlation with more speed bumps to get in versus the amount of crime that occurs. So absolutely. There's also the same correlation with user growth as well, unfortunately. So you have more requirements to open accounts. Surprise, surprise, it's harder to get customers to do the same. Good and bad customers. So there's absolutely a correlation, because all of it for the bad actors is every extra step is more cost and effort, and more cost and effort ultimately erodes from their profitability, right? So yes, but also the downside for the good user side as well, unfortunately.
There are two questions on international high-risk kind of countries, so I'm going to combine the two. Do you think high-risk countries are developing, or developing countries? No, do you think fraud and financial crime is often perpetrated by international actors? What can we do against this dynamic? And I think the other person is asking about the role of high-risk countries.
Well, I mean, the obvious thing is to determine, the obvious starting point is to determine which countries are high risk, right?
Yes.
I mean, the European Union high risk, so country list is all well and good. FATF list is also, obviously valuable, and both of those are regulatory expectations. And it's interesting by the by to see Cayman and Malta added to the FATF list recently.
Yeah.
We'll see if they get added to the EU list, but either way, those are a good starting point. But what is high risk to your institution from a country point of view, and indeed from a financial crime risk point of view, is going to vary. If you're looking from a fraud point of view, depending on whether and actually, as Kevin said, it's not necessarily about where your customers are based, or is it where the people who are interacting with you and your customers are based. So India might be high risk from a cyber security perspective, but maybe it's not as high risk if your clients are there, and so on. And so you need to know what question it is you're trying to solve. And again, as I said before, it's the risk assessment, the risk rating sort of piece is the important thing. What are the different factors that you put into your risk rating? Are you considering different types of financial crime? Do you include them in one place? Yeah. Do you want to have a risk rating for sanctions for a country and a separate risk rating for money laundering and a separate one for fraud? Maybe for some that's over-engineered, maybe for some it's not. Yeah. So I think, that for me is the starting point. Understand what high risk actually means to you, and don't just rely on the EU and FATF telling you.
Yeah, I think the interesting thing about international threats, it's really, it goes back to, if you're in a country where the local law enforcement aren't really going to care if you send a request to them to go catch a criminal in that country because they're defrauding a UK merchant or a US bank or whatever it might be, then for them, the actual risk is quite low because the police aren't going to come after them. So like, I could go get a job at McDonald's, or I could do this, and even if I get caught, I'm probably not going to go to jail because the local enforcement, as opposed to countries like the UK or the US, whereas if a request is made to go and catch a criminal, they're probably going to follow through on it. So it's kind of a higher risk for that person. It's like, maybe I should go work at McDonald's. Yeah. So you'll actually see, and we've seen people outsource to other countries for like social economic reasons. It's cheaper to kind of outsource from one to a different, and it's fascinating kind of watching the, kind of how the cyber criminal ecosystem kind of works. Like one team builds the tools, another team puts the identities together, another team can buy like the money meal process, and you just buy what parts you need to make your attack successful. You don't actually have to run the whole operation yourself. It's a two-sided market, and as you buy more from their services, they invest in getting more of them, and then that drives the ecosystem. It's a large business, and it's a very profitable business.
Yes, so unfortunately we're out of time. I'm going to quickly ask one more question because that's a bit, it's something we haven't touched yet. And there are a few questions on fraud, so people might catch hold of you, Kevin, a bit later.
Sure. We have a booth. Come by our booth. Yeah. We have Tim Tams there. So
very quickly, how much data sharing is there between organizations?
From a bank standpoint?
There is some data sharing. I think the interesting area, I'll be very quick on this one, that is coming, and people have been talking about for literally decades, but actually might be happening, is some of these organizations that are looking to be able to share KYC data in obviously a secure regulatory way. And I think if that works out, SWIFT and others are looking at building these sorts of networks. If they can build that out, that could potentially be a real advantage, because our institution and all of your institutions, we're all doing KYC on the same individuals or the same entities, right? And with complex entities, that can take a lot of time and cost a lot of money. It does seem a bit of a waste of time if we're all doing it separately. So I think there's some real value there. So that could be an interesting way to go.
Yeah, from an ARCO standpoint, all of our customers share data across our network. So it's anonymized, of course. If we see a threat at one bank, we don't tell the other bank it was this bank, but we'll say, yeah, we've seen this user, they were fraudulent, these are why they were caught for it. And that's a huge advantage we bring that they can't themselves do. They only really see their isolation of threats against them, but like attacks are all pretty similar, unfortunately. Like, you're not really unique. No matter who you think you are, and no matter how unique you might think, we've seen attacks the same across the whole industry. So that's a huge advantage when you share data.
Great. Well, I think it's a good sign to run out of time. So thank you, everyone. Thank you, Kevin and Andy.
Thank you.
Thank you so much.
Okay.